So Wealthsimple finally allows you to trade futures. But do you really want to trade futures? Do you know the strategies, the risks? Or all you know about futures is this post from Wall Street Bets where someone made $50,000 by buying a single gold futures contract a few days prior. Before we go to the social media part of things, I want to go through this. Before we get here, I want to talk about what they are, what they do, the risks they present, and everything else you need to know about the futures. So stick around. So first of all, in my previous video, I've mentioned that I really want to go over this article because I've read it and it's really nicely laid out for somebody who does not really understand what futures are and how they're different from options. For example, of course, here they don't actually discuss the futures versus options. We can look into that as well because options have been getting a lot of hype online, but futures haven't been. And there is actually a reason for that. So let's take a look. Futures trading lets you bet on where the prices are headed without actually owning the underlying assets. It's how airlines lock in fuel costs, farmers guarantee crop prices, and speculators try to profit from market swings in everything from crude oil to S&P 500. But futures are in stocks and the mechanics work quite differently. Leverage amplifies both gains and losses, contracts expire on fixed dates, and margin calls can force you out of positions at the worst possible time. This guide covers how future contracts work, the risks involved, and what it takes to get started. So once again, I guess if you stop watching the video right now and you have to pick up a tidbit of information, just think of it as amplified gains and losses. Trading futures is not for faint-hearted. So future trading involves buying or selling standardized exchange-traded contracts that creates an obligation between two parties to buy or sell an asset, like commodities, stock indexes, or currencies, at a predetermined price on a specified future date. So note this word an obligation, which we'll get to very shortly. So unlike buying stocks where you own a piece of company, futures let you speculate on price movement without ever owning the underlying assets. And here's the part that makes futures both appealing and risky. You can control large positions with a relatively small amount of capital, thanks to leverage. And of course, we all know leverage. Just borrowing money to increase exposure to an investment's returns. For example, you can use the 5x leverage. So if the stock goes down 20%, you lose everything. But if it goes up 20%, you actually gain 100%. So there's a great upside, but an equally great downside to this. So what exactly is a futures contract? Think of it as a binding agreement. Exactly. Binding. You can't just back out of it if you cannot pay for it, essentially, right? One party agrees to buy, the other agrees to sell, and both lock in the price today for a transaction that will happen weeks or months down the road. The future in futures refers to that settlement date. And of course, everything is standardized by the exchange where it trades. You don't just trade with a person. There's a middleman that actually arranges everything. So then you're responsible to this middleman and the other person is as well. Yeah, exactly. You're not negotiating custom terms with each counterparty. And that's what makes futures liquid trade. And I mean, we don't really need to go in depth here, but yes, each contract spells out several critical details. Underlying asset, what's being traded, that's pretty simple. That's probably the easiest one. Then contract size, the quantity per contract. For example, 1,000 barrels of oil. Tick size, so this is the minimum price movement and its dollar value. So as long as it goes up by that tick or it goes down by that tick, you either make or lose some money. And the bigger the tick, the more the price has to move and the more money you make. And the expiration date when the contract settles, of course, again, similar to options, they have to have expiration dates. Settlement method, cash settlement or physical delivery of the asset. And this is kind of the funniest one. There's a lot of jokes that you just ended up with 1,000 units of cattle or 1,000 barrels of oil on your property you don't know what to do with. But that's mostly just a funny story, and it may have happened back in the day. And then margin per contract, the deposit you need in your account to open and hold a future position. And so they have a little comparison here of futures versus stocks, and it's not very user-friendly. You see this little guy that just keeps moving up and down. Really upsets me. Okay, so they expire. There is you can use significant leverage if you want. Trading hours is essentially 24/7. And there is no restriction for short selling. But again, note this contractual obligation only. So futures trade on regulated exchanges like Chicago Mercantile Exchange, CME, and you don't trade directly with another person. A clearinghouse, so not a middleman, but a clearinghouse sits in the middle, becoming the buyer to every seller and seller to every buyer. And exactly, because it eliminates counterparty risk. You don't have to worry whether the person on the other side of your trade will honor their obligation. The clearinghouse guarantees every contract. And of course, that makes trades a lot easier to perform, There's one less thing to worry about. And of course, obviously, you don't want to find yourself in the position where the other side simply cannot pay you back. Here, another key difference from stocks. Future positions are marked to market daily. That means profits and losses settle at the end of each trading session based on the current market price. If your position gains value, cash is credited to your account the same day. And if it loses, cash is debited. This daily settlement continues until you close your position or the contract expires. And again, that's another reason it's more dangerous. If it swings up like crazy one day, you cannot just afford to hold for a couple of weeks because you know it's going to pass. That's unfortunately, it's not a thing in futures. If Brent crude oil all of a sudden goes up over 50% in a day, you're probably screwed. And depending on how leveraged you are, you might end up owning more money than you actually have. Anyways, long and short positions, going long, going short, I think that's pretty clear. And unlike stocks where shorting requires borrowing shares and paying interest, futures trades can go short as easily as going long. There is absolutely no restriction. Oh, and here's a good example for the little ticks. So you buy one E-mini Kale futures contract when the index is trading at 4,500 points. That's the current value of the index itself, not a dollar amount. Each point movement in the index is worth $50, a fixed value set by the exchange. If you sell the contract at 45.20, you've gained 20 points. Multiply by that by $50 per point, and you've made $1,000 profit. If the index had dropped to 44.80 instead, the same math works against you, $1,000 loss. So while it's fairly clear, you just have to understand that this is not a dollar amount, these are just the points. And depending on where they trade and what's going on, you will owe each point will be equal to a certain amount of money. So what's going on here? Leverage and margin, of course, these are my favorite parts. I'm terrified of both of them. But leverage is more what makes future trading both appealing and risky. Rather than paying the full value of a contract up front, traders deposit a fraction, typically 3 to 12% called margin. This isn't a down payment or a loan, it's a performance bond ensuring you can cover the potential losses. If you're trading a contract with $100,000, you might only need $5,000 in margin. That gives you 20 to 1 leverage, which means a 1% move in the value of the underlying asset creates a 20% change in your account equity. The math works in your favor when prices move your way. When they don't, losses add up quickly. The higher the leverage, the higher the risk. So 1% up, 1% down. And this one is a little tricky. And I mean, when I first read about it, I remember I was like, okay, this does not really make sense. Why do I need two separate margins? But let's take a look. So initial margin is what you deposit to open a position, and maintenance margin is the minimum equity you need to keep the position open. So they have a good example here. If your account falls below maintenance margin due to losses, you'll receive a margin call. And you hear a lot about margin calls, especially in Wall Street Bets subreddit, and we'll get to that in a second. So your initial margin is higher at $6,000. The maintenance margin is $5,000. Your account can absorb $1,000 in losses before triggering a margin call. Once triggered, you need to deposit additional funds or your broker may liquidate your position. Margin call is something that amplifies your buying power by pouring money from your brokerage. You're required to deposit a minimum amount, known as margin requirement. The remainder is the amount you borrow from your brokerage. The brokerage holds your position in your margin account as collateral for the loan. And of course, margin calls occur if you have purchased securities on margin and the value of your account falls below the margin requirement. And here's a great example of it. Let's say you have $1,000 sitting in your account and you want to use it to buy security with 50% margin requirement. This means you can borrow up to $1,000 from the brokerage, represented by negative cash balance, if you use the combined $2,000, $1,000 of your own money and $1,000 from the brokerage to purchase the security. Your account balance and margin requirements are as follows. So you have negative $1,000 cash. This is the amount you owe the brokerage. Security is $2,000. Margin requirement is $1,000 and margin call is $0. You can see above that you're not in a margin call, again, because it's not negative. If in a few days later the price of the security drops by 10%, the value of your account has decreased and the combined value of cash and securities has fallen below the margin requirement. This means you're now in a margin call. So same cash, negative 1,000. Security is now 1,800 because, it decreased 10% from the original value. Market requirement is 900 market value of the security multiplied by the margin rate. And so you have the negative margin call right now. Negative margin call value, which is a cash market value minus market requirement. Very easy calculation. And so it gets triggered. And so you must sell your securities or transfer more cash to keep holding stuff. And oh my God, okay, we're finally back. And yeah, the same leverage that amplifies gains also amplifies losses. We kind of just discussed that. Move in value of the asset to the 20-to-1 leverage position wipes your entire margin. In volatile markets, which current markets have been pretty volatile, I would say whether you're thinking about the MSCI Global Index, S&P, Nasdaq, I think everything's been very, very volatile. Losses can exceed your initial deposits, meaning you could owe your broker money. And this is the scary part, right? So it's not just the money you put in, you can owe more than you initially invested. And that's the scary part. So you don't just lose money, you end up actually owing the brokerage more. So this is why risk management isn't optional in futures trading. Position sizing, stop loss orders, and maintaining account equity well above margin requirements are all a part of managing that risk. So remember, you can trade futures, but just be careful with leverage. It's very, very scary. Let's take a look at the futures markets. So commodity futures, this is corn, wheat, and soybeans were among the first futures contracts, helping farmers lock in prices before harvest. Energy futures, crude oil, natural gas, gasoline are heavily influenced by geopolitical events and supply disruptions. We already know that. Oh goodness, the gas has been pricey lately and it's gonna start bleeding into food and everything else. And metal futures include gold, silver, and industrial metals like copper. Then there is financial futures, which are also pretty popular, just stock index futures such as S&P 500 and Nasdaq 100, as well as currency futures such as EUR USD and CAD USD. Cryptocurrency futures is very interesting because crypto already trades kind of 24/7 and it's already incredibly volatile. You add futures to that would be very interesting. But yeah, these contracts offer exposure to crypto price movements without the complexities of holding digital assets directly. Yeah, I guess so. Again, I've burned myself a lot with this in the past, so I'm a little wary. But however, volatility tends to be significantly higher than traditional futures markets. Okay, and so why people trade futures? Hedging and speculation. Hedgers use futures to manage business risk. An airline might buy crude oil futures to lock in fuel costs. A wheat farmer might sell futures to guarantee a price before harvest. Hedgers aren't trying to profit from price movements. Instead, they're trying to reduce uncertainty. And then speculators, that would probably be you and I if we decide to trade futures. And they aim to profit from price changes. They provide liquidity to hedgers and accept the price risks that hedgers want to offload. Without speculators, futures market would be far less efficient. So that's awesome. Good job. If you plan on trading futures, pat yourself on the back because again, without you, future markets would be far less efficient. Awesome. For individual traders, futures offer several characteristics that differ from stock trading: leverage for capital efficiency, the ability to profit in falling markets, extended trading hours, and access to asset classes beyond equities. Cool. I think that's essentially the most interesting part of this article. I mean, we see the future trading hours here, extended access. You can trade futures all the time, so you can stay in front of your screen even more hours than you already do, getting even more stressed. So that's awesome. But yeah, the most active trading typically occurs during regular US market hours. Makes sense. While overnight sessions may have wider bid-ask spreads. And what does that mean? There is a risk of slippage. And you'll just end up paying more if you buy fair amounts, or just in general, if you buy during these hours, there will be fewer people selling. And so you'll be forced to buy at a higher price than you would otherwise because there would be competition between the sellers. So, and of course, there's a suggestion how to start trading futures. I'm not going to do that. Build foundational knowledge. Choose a future broker, start small, and that all makes perfect sense. A more forgiving way to learn. Tracking every trade and reviewing decisions regularly help you identify patterns over time. Absolutely, you can say the same thing about trading anything else. But I think this is the most important section of this article. Again, for someone who's trying to potentially make a quick buck, right? Maybe they need money for down payment or for the wedding or for something and they just want to take risks. So watch out, futures trading carries substantial risk, leverage risk. Leverage risk, volatility risk, and liquidity risk. So first of all, losses can exceed your initial investment. And this is what I've been talking about, the contractual obligation, contractual agreement, and a margin call can force you to deposit more funds or close position at an unfavorable time. So losses can exceed your initial investment. This is something very important. Again, if you are trading at a margin or you're leveraging yourself and let's say you're doing 1 to 20, you do $5,000 to 100,000, but the S&P index at $100,000 goes down 10%, you actually owe $10,000, not 5. So besides your initial investment, you have to find another $5,000, 100% of your initial investment somewhere, and just pay the brokerage. So please be careful over leveraging yourself. Now, there is volatility risk. Futures prices can move sharply on economic data, earnings, or geopolitical events. And overnight gaps can blow through the stop loss orders. So again, yes, the first advice is, hey, you have a risk, set a stop loss order. But if there is a jump between the end of trading session today and tomorrow morning, there is very little you can do. If you're betting that the market will go up and it opens significantly lower, you're in trouble. And lastly, there is liquidity risk, which is less popular contracts may have wide bid-ask spreads, making it costly to enter and exit positions. And again, right? If there is only a handful of sellers and buyers, there is less competition. They can sell it for more money if they want to. And of course, there's common risk management approaches include position sizing, stop loss orders, and maintaining account equity well above margin requirements. So if you remember anything, just remember the risks of future tradings. There is also cost, which is commissions, exchange fees, data fees, slippage. And if you're an active trader that doesn't just buy and hold for the next 3 months, because that's kind of where they see the price moving. If you want to just scalp it, little profits here and there, then yeah, keep in mind that costs can add up. An approach that looks profitable on paper when you do a back testing may break even or lose once all costs are factored in, not including the cost of your time of actually trying to figure out what futures are. And so, if future trading right for you? I'm not sure if future trading is right for you. Obviously, you should talk to a financial advisor, not someone on YouTube or on Reddit. But yeah, the learning curve is steep and patience tends to pay off more than rushing in. And of course, they say the same thing. I personally don't really like this. Yeah, patience will pay off. You just gotta study. I mean, maybe that's the case. Maybe it's just my experience, right? I know that it's hard to make money with day trading. It's close to impossible. Most people lose money. I've tried that. I've lost some money. I know some other people that did try, and it hasn't really been working all that well. But anyways, before we summarize it, I want to go to Reddit and just take a quick look at what people say about the futures. So first of all, I think Wealthsimple will actually have a prediction market, not just the futures, but the prediction market similar to Polymarket coming out soon. So that would be even more interesting, even more insane than futures. But let's take a look at the futures. So just 8 months ago, people were wondering, so there's clearly demand for them, right? Have there ever been hints of it? I don't want to open another account somewhere else. And funnily enough, they were hiring a director of futures right now. So that would suggest it's likely on the roadmap for next year, if I had to guess. Some people really know what they're doing. I wouldn't have tried to go and, look on their hiring page. But yeah, for the longest time, I guess it has been IBKR here in Canada, and of course, IBKR Interactive Brokers in an American company. So it's good to know that a Canadian firm is actually, leading the way here. I really like that. And I just opened a couple subreddits about actual trading. And some people say I've been trading futures for 4 years. Only in the last year I have become consistently profitable. And they say it's not a scam. It's not fast money. You don't need to predict. You need to react. Risk management is an optional. No strategy works without emotional control. Live trading is 10x, 100x different than demo. Futures require focus. Market humbles everyone. And honestly, when I see this stuff, I'm very wary when someone says it's not fast money, it's slow mastery. I mean, to me, that seems like it's a 15-year-old writing this. Future reward structure, not speed. Forget the one big trade. Focus on 100 good ones. Yeah, I mean, every single day trader has the same advices. I can put this for options. I can put this for futures, stocks, crypto, and it will all apply. To me, it's as generic of an advice as possible. And when you say, trading futures is hard, but it's so worth it, there's a million of YouTubers that will tell you that the same about day trading. Come on, just keep watching my videos and keep studying. I don't know. It's great to try and hopefully it works out, but just, be careful. I've been hearing the same advice for the past 10 years. And I'm sure it's been around for much more than 10 years. But, maybe it motivated some people to go ahead and trade. And I hope they actually made some money. And again, same thing here. If future trading is really this easy, I started a paper trading account through TradingView on the 27th. I'm up $23,000. I want to know if I'm just getting lucky. And of course, some people actually have mentioned that it is all easy unless you have some real money on the line. And I totally agree with that. If you're having no issues in paper trading, then it's time to move on to real thing. just be sure to scale way down for your risk when you start with real money. Yeah, and this is totally true. And you'll go through a boom and a bust phase, and then markets will humble you. You will blow an account, and it's a rite of passage for all traders. And this is something I always say, right? It's great to, everyone is a genius when everything is going up. When things start tanking, that's kind of when you see if you are for real, if you're smart and lucky. Because, in 2020, 2021, you could have money in any stock, almost, and you would be, 15, 30% up on a specific stock. Will make you feel like a genius. But, then everything started crashing and it was not as much fun. I'm going to be honest with you. And of course, people also trade futures in crypto. But my favorite one is, of course, Wall Street Bets, because they simply have the best content, Single gold future contract for 22K a few days ago, and it's already up to 50,000. Just clocks $10,000 every day. Don't be afraid of the futures market like a lot of people in here tell me I should be. Gold to 5,000. And I mean, when was that? That was 7 months ago. And if you look at gold price for 1 year, I mean, it did make it to 5,000. So I wonder if he's made even more money. Okay, what is this? What's going on? Why is there more than one? Oh, bro, what are these ads? They're insane. Oh my God, wedding. Oh my God, what is this website? Oh my goodness, this is horrible. This is so unprofessional. Absolutely insane, man. And I can't even leave. I'm trying. And you see me clicking, right? It doesn't work. They want me to click on one of these ads. That's bonkers, man. Okay, I'm leaving it. I don't feel safe on this website. I can't leave. I can't leave. My laptop is overheating. Oh my God, please. What's going on? Can I open a new tab, please? Okay, I'm safe. I'm safe. Oh my God. You know what? Maybe it is a sign to end this video right now. I wish I had more time to talk about the futures, but this gold website really messed me up. I don't know what's going on here. One thing we've learned from this video, besides a little bit about the futures, is do not go to this gold website. Don't just check the price of gold on the first website that shows up. It's gotta jump scare you. Let me see if I can close it. Oh, we're back. Okay, one last thing. Why don't I hear of anyone here trading futures instead of options? Because that's what I was telling you in the beginning of the video. I want to talk about this because, they sound very interchangeable. Obviously, they're not, but it sounds like they're very similar. And yeah, doesn't everyone in the sub love risk? So why not trade futures instead, where the leverage is higher? I always hear talk of options and only options in the sub. I don't hear much talk about crypto for some reason. Granted, I'm quite new, whatever. Okay. And this is true. I mean, Wall Street Bets is kind of the options hub. You don't hear much else besides it. And I think the best comment to describe this is right here. Futures tend to deliver physical product. If you have 1,000 barrels of oil or 10 tons of grain delivered to a port where you have no warehouse, you're pretty screwed. As the word says, it's a future contract, not optional. That's all it is, right? Obligation. Future requires settlement, while options allow buyer to walk away, losing only the premium. So anyways, I hope it kind of makes sense. I know we went on a couple tangents and I know I struggle with that, but thank you for watching. I appreciate your time. Let me know if you actually plan on trading the futures when Wealthsimple introduces it. I don't know if I will. I might try it out, but again, I just don't have time to do the research, to be honest with you, and no incredible desire to do the research for this, as I don't really know what's gonna happen. But what about you? Thank you for watching, and I'll see you in the next one. Take care.